If you were a key player on the George Soros team that in 1992 helped the Quantum Fund make $1 billion shorting the pound ahead of the UK's withdrawal from the ERM, are acknowledged as a significant thinker, a highly respected macro hedge fund manager, have taught financial history as an adjunct professor at Yale, and a recognised philanthropist, you might know that our guest today is Scott Bessent. Scott's firm, Key Square, has as his firm's mantra, "We study history. We observe the present and try to imagine the future." And that's what I hope we all do today. So Scott, you're over from the US, we're recording here in London, and I have a list of macro and market topics I'm itching to ask, and our listeners will be reaching to hear. So welcome to the Money Maze podcast.
Good, thanks, Simon. And I think our compliance department wants to say this is all my opinion, not investment advice for your listening audience. So I'm looking forward to this.
Great. Well, there's been a lot of press around Elon Musk's father's influence on his career, and you told me that your father had one of the largest collections of science fiction books in your part of the US, and used to sit and discuss them when you were a child. So much so you said that you could point out the Alpha Centauri constellation before you knew where Chicago was. Now, how did that make you perceive the world?
Yeah, it was incredible. So the largest science fiction collection in South Carolina, not a high bar, but my dad loved to talk about it. And we would sit, look at the stars, try to imagine things. Are there people on other planets? If you could believe it, one of our neighbors had a proper observatory telescope. So it's just this imagination that there could be something different. And it could be on a different planet, or it could be, in macro investing, it's kind of regime change, which is, I think, why I gravitated to it. You need a good imagination.
Well, we're going to talk about some of those skills required for your specific part of the business. But you also said your father was a boom-bust real estate investor, and his roller coaster fortunes made you focused on risk management. Watching furniture being carried out of a house that your family has owned for 200 years will focus one's mind on not blowing up. Now, of course, some folks would bet that against such a mercurial backdrop, you would be a risk-averse academic, or you would avoid investments. But of course, that hasn't been the case, and we're going to unpick that. But how did you earn your first dollar?
Well, I earned my first dollar putting out the chairs on the beach for lifeguards and hoping one day to be a lifeguard. But I would say, I think I mentioned to you, I'm a competitive backgammon player. So in backgammon, there's with the doubling dice, there's something called PRAT, the PRAT, and it stands for positioning, racing, and threat. So do you double? If you have 2 out of the 3, you double. So I tend to be more focused on the threat.
Right, and that is absolutely what we're going to talk about a little bit in detail. But you choose Yale. I'm always intrigued. We've had lots of people from lots of different backgrounds. Why Yale?
I think I wanted to get out of the South. It was a medium-sized city in New Haven, near New York, but not New York, and a great reputation. Yale had the host of distinguished alumni from South Carolina. Before the Civil War, Charleston had the second or third most students at Yale. So there's a big South Carolina tradition. And I didn't know what I wanted to do. Do I want to be a journalist? Do I want to be a computer scientist? And keep in mind, this was 1980, that the computer science department had just switched over from cards, which I think probably the 80% of the people being part of this, they can't imagine, and to the mainframes. So I was back and forth between quantitative and qualitative, and Yale was a good mix.
Right. Now, I understand that you actually did get your first job as a securities analyst for the investment firm of a Saudi Arabian family.
Right. So my first job was actually with George Soros' old partner, Jim Rogers. It was a summer internship. He had, when I look back at it, I'm not even sure you could put this on a bulletin board now, but it was analysts wanted, do spreadsheets, make lunch, and you can sleep on the sofa if you don't have a place to live. And I didn't have a place to live. So you can imagine 107th and Broadway in 1982 in New York City was quite spicy.
Right.
But it was an incredible experience. Jim is one of the great researchers, just research. And I could see how he and George Soros were this incredible pair with Jim's research and then George's market instincts. It was the incredible combination.
Do you go and work as a securities analyst after that?
Yes. So I did a training program at Brown Brothers, and then I went to work for this Saudi family. And again, counterintuitive, but South Carolina and Saudi Arabia had a long history. The governor of South Carolina had been U.S. ambassador to Saudi Arabia. So, and this family is incredible. They're one of the most prominent families still. The father came, I think, to the U.S. in the early 60s, saw New York, and used, unlike sort of most Saudis of his day, he didn't want to meet movie stars. He didn't want to do this. He wanted to meet CEOs. And he was generating this incredible cash flow from servicing all the Aramco employees. And he just kept reinvesting it into U.S. companies. And he got right in at the bottom, 1975, and had the ride of a lifetime. And they are the most understated, the hardworking Middle Eastern family. I'm still very close to them, and the next generation's taking over, and it's incredible to watch the work ethic.
So you end up running, when you go back to work with George Soros, you run the London office for 8 years. You work with Stan Druckenmiller, and we'll talk a little bit about mentors later on. And you obviously had some very high profile successes. And then you set up your own firm, Key Square, and that's when we're going to start talking about the markets. But just a bit of reference for for our listener community. Some will be very familiar with global macro, some less. But if you were to describe global macro at its very essence, how would you describe it?
You are observing the world, you're observing markets, you're observing what you think should happen, and you're observing what is happening. And it's good and bad that you can look around the world and you're looking for mispricings. You are looking for policy errors. You're looking for political changes. So basically, you are looking for change on the margin, and you want to see what the market is giving you. What is the market giving you? What's the opportunity set? Because you might think you have a great idea. You might think you split an atom, and then it turns out everyone else believes it. But, look, the interesting, a good example would be October 2016. I didn't think Donald Trump was going to win, but I thought he could win. No one else thought he could win. I actually had a big bet with one of my neighbors in the Bahamas, who's quite a prominent currency speculator on that.
Got it. So you launched Key Square. It was one of the largest hedge fund launches ever. I think George Soros was a $2 billion anchor investor, and I think you had sort of $4.5 billion, within 6 months. Key Square, I have learned, as I have done my research, is from a chess sequence. I'm not a chess player. I'm not a backgammon player. But you say that it doesn't take long for a beginner of chess to learn that the end game is the most difficult and complicated part of the game, despite there being less pieces on the board. So help the non-chess players in the audience here understand, you would have given a lot of thought to that name. Why?
Sure. So a lot of what we do, back to your question on what is global macro, that you can have these big trends, and you can either be part of the trend, you can ride the momentum. George Soros's theory of reflexivity is really a momentum strategy. If it's going up, buy it. If it's really going up, buy more. And at the turn is when you can really make a lot of money. So with Key Square, it's when there are just two kings, several pawns, and there is one square you can move to, and you win. So if you think about the financial markets, many times there is one investment you can do, and you win. whether it was John Paulson with the CDO, CDS in 2008, whether it was Stan Druckenmiller shorting the pound. It's kind of again and again, you see these things, and it's, we try to keep things very simple. Is we have few positions, and where are we going to, and what is the key square?
So you're continually looking for that position that will enable you to win with the least risk. We have information overload. How do you separate noise from signal?
So I actually don't have a Bloomberg. The former mayor, doesn't like for me to say this in interviews, that have an incredible trading desk is, for me, there's no information value in watching things turn yellow or red constantly. We have a lot of respect for the markets. I look at 270 charts every night. We're not a think tank. But you're just looking for either things that are changing, anomalies, or what you think is clearly a mistake, or that something that's maybe unsustainable, and then you identify why now. Is that unsustainability going to break?
So as we think about, and the industry likes to talk about micro and macro, you have written, we don't have an edge in predicting non-farm payrolls, but you can learn a lot from what corporates are saying about wages, hiring, and capex. And the cynic would say, well, so can everyone. So what is it that you think you do or use with that information that gives you an advantage?
So I think what's different is, if I look, one of the few good things about being 61 is I have a lot of data. So I've been doing this a long time. And if I look back, in terms of asset classes, foreign exchange has been our biggest dollar winner since I started doing macro in 92, followed by equities. And I think that when we're talking to a company, we aren't necessarily trying to get an edge on the company. We're trying to get an edge in the economy. So that, everyone's trying to predict the Microsoft earnings, or, everyone's trying to figure out the FedEx earnings. I'm trying to figure out what is the FedEx wage round, or what is the UPS wage round. If it bleeds into a FedEx wage round, then tell me about, a wage price spiral in the US. So, it's the same information. We just have a different use case.
So this comes back to your earlier point about macro investors almost need to have a flexible imagination.
Sure. It is, we're on a podcast. These didn't exist 3 to 5 years ago. When you think about the, how many jobs there are that didn't exist. We were just talking about what will our sons do. Job probably doesn't exist, but you just got to train them well for how it does exist.
I remember a great macro thinker, David Roach, Morgan Stanley's strategist, coming in after the Berlin Wall had fallen, and the consensus was, rates rise, this is awful. And he was unequivocal, you just go and buy German equities. It was that, he saw the unification beyond the rising cost of capital. And of course, it was, for a while, an absolute home run trade. We might talk about Germany's, more troubled situation later on. Let's talk about, did you want to?
Oh, no. And again, things are counterintuitive. Right, like you just said it was a home run trade, and then it was a terrible trade, right? Because that there was the impetus, or the shock, the demand shock from rebuilding the East, and the US-mark and the D-mark coming at parity, which no one could believe. So that's a shock, probably a policy mistake that led to a great deal of inflation, and then the Bundesbank pulled back the liquidity, right? And then, that set off a chain reaction collapse in European equities, which is actually how I ended up in the Soros London office. The Bundesbank actually put me here.
Okay, explain that. Get just a little vignette.
The then manager had a very large position in what you would call a reunification play. which worked well for a bit. Then when the Bundesbank decided, we're the Bundesbank, we don't like inflation, and they started hiking rates aggressively, the shares collapsed. So there was a management change in London. So, so it's always sequencing is very important in macro. Sequencing is, right now, and maybe we'll talk about it later, is there's clearly a slow motion de-dollarization going on, but could the initial stages be a dollar rally because countries are paying back their dollar debt? So there's a dollar thirst before there's a dollar boycott.
Well, you can't see my sheet of questions, but as we move to investment themes, number one is de-dollarization. So you already jumped in there. So how do you think about taking that idea, which I guess many people would say isn't controversial, that the dollar loses, if not its hegemony, its relative status? How do you think about the journey ahead, and how do you think about, as an investor, when is the right time to build your positions?
Again, we look for stress in the system. We just did a 3-day offsite here in London, and I came away thinking we had these kind of meta long arc ideas, and the challenge here is, as you just said, where to implement them as actionable market ideas. You see things happening on the margin. This Shanghai Gold Exchange, very interesting. We see India and China being able to pay for oil, which is the ultimate dollar commodity, and the rupees and RMB. So you've now moved the U.S. out of the way. So, and I'll tell you, is the real wake-up call for me was last December, and we were doing a call with one of our consultants, the much older fellow, great thinker, and French, and he said, I was used to, okay, the U.S. has sanctioned Venezuela, the U.S. has sanctioned Russia, U.S. has sanctioned Iran, and he said, it is untenable that the U.S. can extend its foreign policy to the French government via the dollar, and just this huge multi-billion-dollar fine on BNP is going to make a U.S. ally want to think of a new way of doing business. So, you have this new term, the global South, that wants out of the dollar system. Very interesting if French Republic wants out of the dollar system.
Yes, and the seizing Russia's reserves has probably only accelerated that.
They haven't been seized. I'm told they're frozen, right? But my inclination is that they will disappear.
So all of this debt swirling around the system, one is, as an investor, should be thinking about the preservation of purchasing power almost above all, and therefore currencies has always been a relative game. And I sometimes get some criticism from my partner, Will Campion, about the fact that I'm a long-term believer in gold and a distruster of the central banks. You have written about gold and have painted a scenario.
Gold is not a fiat currency. There's a limited amount. It is recognized as a store of value. And, you are seeing that you can keep gold in your vault. You can move it back. I am adamantly anti-Russian, but the mistake the Russians made was the Russians got onto war footing in terms of their foreign exchange reserves, but they moved out of dollars into euros, and they never believed that the Europeans would have the wherewithal, the inclination to follow the Americans. If the Russians had moved entirely into gold, price would be higher, but they would have all their reserves in Moscow. So I think a lot of the who knows whether China's moving on to war footing vis-a-vis Taiwan. The Chinese PBOC is the largest buyer of gold now. So could we imagine, again, back to imagination, could we imagine some kind of a RMB that is exchangeable into gold, maybe at a premium.
So I don't disagree with any of that, which is probably why I find myself constantly sort of rolling my eyes when people mention Bitcoin.
Gold can be a risk off and a risk on asset. Bitcoin is a risk on asset. So
plot that chart of Bitcoin against Tesla up until recently, it had a correlation that was almost perfectly one.
Yeah, and as someone who spends a lot of time in the Bahamas, one is skeptical about some aspects of crypto and getting it back.
Enough said. Let us talk about Japan. You have had, I think, rich pickings there in the past. You've been writing about it again. I'm going to just quote you when you say the Bank of Japan will be the final central bank to exit from ultra-loose monetary policy and the global ramifications will be profound. Now, as I follow these currencies, I did run the charts the other day. I think that Japan's purchasing power parity is at the most extreme ever witnessed. So that's either the elastic has been stretched or it's the first of these collapsing currencies courtesy of its debt. How are you thinking about Japan, number one, and how are you planning and playing the three legs of that stool, which is the FX, the bond market, and the equity market?
Right. So, little history. I went to Japan first time in 1990, 91. Spent 90 days at the Okura Hotel. It was the then incredible price of $500 a night. The Okura Hotel, they just remodeled it, but it's still about $500 a night. We're sitting here in London. I'm not sure. I can get a shed for $500 a night. So Japan, if we rewind to 2011, we had this terrible, it's easy to remember, 3/11/11, the terrible Fukushima incident. And Japan looked completely hapless. The yen, they strengthened. They've been through a series of prime ministers, and they had this gigantic current account because after the collapse of the bubble, I'll go back, is 91, the Nikkei peaked and then just kept dribbling down for 20 years. And we were just the opposite then. So the yen was 78 to 82, and it was PPP, which we use as a gauge. Trading currencies off PPP, you lose all your money because currencies can stay cheap or expensive longer than you can stay solvent. But it was the most expensive currency in the world, and we come back around summer 2012. China was starting to rattle the saber over the Senkaku Islands. The Japanese were feeling set upon. The Obama administration had basically shown up and said, not so much. You're not relevant anymore. And the Japanese panicked. One of our consultants called and said, there's this fellow named Abe. He used to be the prime minister. He's going to come back. He's got this program, and at the time it was called 3-3-3. Then he changed it to 2-2. 2% inflation, 2 years, 2% inflation, 2% growth. And, back to imagination, no one believed he could do it. But, so we had a theory, and then it turned out that there were all these seats opening up on the Bank of Japan, including the chairmanship. And, so you had a cheap currency and the potential political will to change that. And, off the bottom in October, the yen was trading 78 to 82. By the spring of 2013, what we call Abenomics had taken place. New chairman of the Bank of Japan, a new governor of the Bank of Japan, Governor Kuroda, put in the big boom, went to ultra-loose monetary policy. And I remember George Soros and I went up to Yale and visited one of the architects of Abenomics, and we had lunch with him. And on the way back, George said, "Do you think this is going to work?" And I said, "I have no idea, but it's going to be the market ride of a lifetime." And it has been. It's been incredible. So we go into 78 on the yen. I think when I walked in this morning, it was approximately 148.20. I think it peaked at 152.70. And now they have the opposite problem. They were in deflation. Now no one could imagine that Japan could have an inflationary spiral. And since 1991, Japan has actually, you call it the malaise, but Japan has actually done an incredible smoothing operation. And they've just added more debt. And they've actually had, in terms of statistically measured recession, they've only had very few down quarters because they've just spent so much government money. So, had a huge amount of real estate debt. The government then took it on, and now they monetized the debt. And now they're seeing real inflation, both imported globally and for the first time, wage inflation. So I think that they are running a high pressure economy. And to get back to your question on the three asset classes, my guess is that the Nikkei and the Topics are going to break through the all-time high. That they're part of Abenomics. There's also loose monetary policy, but there's this incredible sea change in Japanese corporate behavior. So that's back to observing the companies used to keep a lot of cash on the balance sheet, and my friend Jim Grant actually had a Japan fund that was based on the old Ben Graham net cash position. And I said, well, Jim, it's a good idea, but in a way, the most dangerous thing is a Japanese company with a lot of cash because they'll do something crazy with it, right? They have this incredible manufacturing ability, and they are less good in financial transactions. So now we're seeing excellent return on capital. The Abe administration put in minimum returns, or you get delisted from the Tokyo Stock Exchange. So I think over the next few years that probably Tokyo will do the best of any major market. And the other thing that's happened too is you're seeing this reshoring in Japan. The semiconductor industry, I was talking to someone, there is a university down toward Okinawa, and Taiwan Semi is hiring every graduate this year, and they're doubling their salaries. So, again, Japan, in terms of kind of offshoring, the U.S. changing supply chains, Japan's a key component. On the currency, there's a new governor, Governor Ueda. I've met with him many times. I think he's an incredible thinker. For an academic, he loves markets. When I was at his office at University of Tokyo, there's a Bloomberg, unlike my office, the pulsing in the background. And I think he's realized that they've been successful in getting them out of deflation. And I think we've got to have a lot of imagination. And so Japan is in NIRP right now, negative interest rate policy. If you have this huge pile of savings and savers who have gotten nothing on them, if you need to raise rates to 1% or if you do raise rates to 1% to stop inflation, strengthen the currency, could you really end up with something that picks up a lot of strength because Japanese are huge savers. So now you're handing them extra cash. It's almost like a helicopter drop into their bank accounts. And I think no one's imagining what that could look like in 6 or 9 months. And one of the things we think about a lot is policymakers are people. Jerome Powell reads what the New York Times writes about him. Ben Bernanke, wrote a book. Sounded like he was the head of SEAL Team 6, like the courage to act or something. And I think Governor Ueda will understand that the Prime Minister Abe was assassinated. The legacy of Abenomics, they don't want it to end up with a financial bust, either in Japan or globally. So I think they will move to quell inflation early.
So I remember working with Barton Biggs, and one of my most successful PA trades was buying the dollar against the yen when the yen was so strong. And so I've been sort of itching to put that trade on. But right now the market has just played the advantage of the higher US interest rates and shorter the yen. What will be the trigger for you to get really long the yen?
Yeah, so it'll be twofold. Is one, I would say that there is a position, because I perceive there's been a change in monetary policy. So we've had a change of personnel with Governor Ueda. He has started hinting that there is going to be a policy change. And we are observing from Japanese corporates a pattern of price increases that, if you hadn't raised prices for 20 years, you start out at 2 or 3%. Now they're raising prices 8 to 12%. And it'll be a 1-2 combination, because it'll be a combination of Japan is coming out on this side. And then, with the US, yesterday we just took out 2 interest rate cuts for next year, clarified a hike for this year. So, my guess is you see some kind of back to currencies being relative. You see a big relative change in expectations that the Fed has maybe finally slowed the economy, which is difficult given the amount of government spending. But that the Bank of Japan is just beginning a cycle. So the Fed, we'll see. Have they gone a step too far? But they are closer to the end than the beginning, and the Bank of Japan is just at the beginning of the cycle. So look, we want to see both legs to have a full position. But again, the market's giving you a lot here. It is very few people are interested in owning the yen. If you look at the CTA, the commitment to short yen, quite large.
Let's just pause and look at China. And what are their fiscal and monetary options? And you said that we're seeing the end of a multi-decade leverage cycle, in China. How are you thinking about China as an investor?
So not Chinese New Year 2023, but 2022, I was invited to a very, very nice dinner in New York, and everyone had followed China for a long time. So you can imagine the early 22, people still very constructive on China. And I had a long-term secular down view based both on the economics, gravity, because somehow everyone thought, well, China's so big, they have this closed capital account. If it were any other country, it already would have exploded. But the view that gravity would win. And then I also had the view that when party chairman Xi came in, he's a different kind of cat. And, this very unusual capitalist communist blend that had taken China out of the dark ages and into the modern world was over. So now we've seen they've gone to more of command and control economy. But, so at this dinner, I told everyone at the table, I said, you can have China. I will take India and Japan. Let's reconvene in 5 years. So, I think it's this Leninist model versus the Japanese democratic model, and then the Indian very loud democratic model. But, I think you can sort of avoid China. And look, I think that they can have a cyclical bounce here within the secular down. They have some very difficult policy decisions to make. They've starved the consumer or starved households in favor of manufacturing. And doing the rebalancing is very painful. You have a lot of vested interest, and especially at the state and local level, and you've got to move it over to the households. And these municipalities, states are not going to sell off assets willingly, but it's got to be done. And then you have the Taiwan question. I would say that is we try not to play fort and predict these things, but I think we have to imagine. Our mutual friend Neil Ferguson wrote a very good piece last week, and it had two parts to it. One was, are the U.S. and China in mutually assured financial destruction? So, in game theory, an escalating tit for tat is one of the worst patterns. So, the U.S., the kneecaps Chinese tech growth by a semiconductor, high-end semiconductor ban, and then Chinese government starts getting a little squishy about Apple. Maybe government officials can't have them. Maybe there's been a security breach. So, if we see that financial tit for tat, that's a market event. I think, we'll see. Taiwan has elections in January. The leading separatist candidate is doing quite well. He's pretty aggressive. We'll see what U.S. policy is. And I think we have until the election to see, but we'll see how President Xi responds. That we're concerned. China they have been sucking in oil imports. So, if you were going to go on war footing, you would need energy, you'd need food, and then you would probably sell your treasuries.
So before we leave China, I had this macro question, which is, if you're a bottom-up investor, you'd look at Alibaba or Tencent, you'd say world-class companies operating with great profitabilities and trajectories. I'm sort of drawn to them. Does the macro investor go, I don't care because the geopolitical risk and uncertainty is too profound?
I think there are two things here. Is one, are you a tactical investor? And these things could be very interesting. Or are you an endowment long-term investor? And at that point, what everyone always asks me, what is risk? And I said probability and severity. So if you think about those positions, what is the probability that you are going to have 100% loss? It is not zero. That you walk in one day and you have just had a Russia into Ukraine event and the stocks went to zero, or you're not allowed to own them anymore. So, but I see your point that we are getting to, if I just look at a chart, because I was looking at the chart of the K-Web, which is the China Internet Index, it looks like you could go down 10% and maybe up 50. But there's probably a 20% chance you can go down 100%. So, when you think about it in terms of outcomes, so for tactical investors, very interesting. For an endowment, a pension fund, a sovereign wealth fund, probably less interesting.
Very well put. Now, as we talked about military conflict, here we have this Ukraine situation. It was General Petraeus, who was on the show in January, who said all wars end in a conversation. And one can imagine that has to be, a high probability that there is a conversation. And with it then, the next step becomes a rebuild of Ukraine, potentially of a scale that we haven't seen.
Exactly.
How are you thinking about exploring that theme?
Right. So for us, framing a problem is the most important thing. Can we, Yeah, and if we're losing money, I usually think our framing is incorrect. So in terms of framing the scenario you just outlined, I think I don't have to worry about that yet, because I don't know what I would say there's an 80% probability Donald Trump is a Republican candidate. Is there a 40% probability that he wins the general election? If you were Vladimir Putin and former President Trump has said, I am going to end the war in 24 hours, you're not settling. So November 5th, 2024 is when the talking probably starts. Right? It is, Trump wins, comes in January 20th, there's a conversation. Biden or the Democratic candidate wins again, then maybe Putin, I'm not in this for 24 more months. This is a meat grinder. I'm going to run out of prisoners from Vladivostok. So when you game out the potential pass, I think no conversation starts until November 5th. Like we always focus on signposts. Again, I think that like you don't have to have a conversation. You can have lots of observations, but I don't have to have a conversation on what China might do in Taiwan until I'm cuffing it. But I think the Taiwanese election is January 17th, is DPP, which is the anti-unification party, wins. Then you got to start thinking, could this turn kinetic? My guess is it's more of a blockade, right? But look, this Ukraine tragedy, there will be an incredible rebuild. It'll be something, back to the fall of the Berlin Wall.
And I think what you said is, as I look back at my own investing career, spanning since starting in the mid-'80s, and if there's been a persistent mistake, it's trying to be too early. And what you're saying is that you need maybe a convergence of the fundamentals and also the technicals. I
always tell everyone who works with me, we're not a think tank. We're a money management firm. And the technicals, Bruce Kovner has this great saying, is an investor who doesn't look at technicals is like a doctor without a stethoscope. And I think even like Barton loved technicals. So like the mind of the market. I don't think I'm smarter than the market, and I certainly don't think I have more liquidity than the market. But there are a lot of signals,
which of course leads us. Well, it may not, of course, it's going to lead me to talk about AI. Now, you've written about how AI can impact productivity. You've also talked about how regulation could help or hinder countries. I'm thinking of the US juxtaposed with Europe, in that regard. How are you thinking about what AI does, and how is it, or do you think it will influence your positioning?
Yeah, so my guess is it is business out 2 or 3 years, but we're also already starting to see it. That I was on a Zoom with one of the most prominent tech overlords, and he said he kind of, for those of us on the Zoom, he did a trip around the world, and he said China will never let AI meaningfully into the private sector because they will be convinced that maybe Jack Ma with AI could take down the CCP. So you will not get this private sector productivity enhancement in China. He was of the view that Europe was already starting to regulate it away. And unfortunately, the UK seems to be following the European model. And the US, as we tend to do in the US, he said, was the wild, wild west. And it could be incredible productivity gains for the US if we don't blow ourselves up. But you're starting to see the use case for this. My guess is the big winners, just like with the internet, no one knew. Google was founded in '98, appeared in the early 2000s, so 3 or 5 year lag. Facebook, Amazon. So like those companies don't exist yet. My guess is the super scalers who are trying to get on this, Microsoft, Google, Amazon, Oracle, Meta, are going to be spending a lot of CapEx. They may or may not be the big winners. And the big winners could actually be US corporates who are able to get these big productivity gains. So, you could imagine 2 or 3 years out, this big cut in employment in maybe white collar employment, back office.
So in short, would you say that AI has extraordinary possibilities, but huge dispersion in how governments respond around the world? And as an investor, you're watching closely.
That's a fantastic summary. And if I think about what is today's business with AI, I would think these hyperscalers are the most cash-rich and we could come back to the sucking liquidity out of the system. The hyperscalers are the most cash-rich companies in the US. And I think Apple would probably be the biggest sovereign wealth fund after Norway. So I think I left them off the hyperscaler list. The hyperscalers are probably going to spend between $500 billion and $1 trillion on the data centers for AI. I mean, this is an arms race. And what happens when they start spending the cash rather than accumulating it? What happens when Apple is selling IG credit to have bricks, mortars, and NVIDIA chips near a power facility in Nebraska, right? So like this is just another model change in terms of the savings glut actually getting pushed into the real economy.
Which of course brings us to this question I have in front of me, which was sort of summarizing today's climate. And you've written a lot about this savings glut. We all know about these cumulative levels of debt. We all read the history books and know that, inflating your way out is one of the routes. But summarizing today, it's a paradigm shift. It's a changed order. Is that fair?
Yeah, look, we've had 40 years of deflation or disinflation, and now we're going the other way. So I started university in 1980, started in the investment business in 1984. For my entire adult life, capital has gotten treated better to the detriment of labor. Thatcher came in 79, Reagan came in 80, and then, life just kept getting better for owners of capital. NAFTA, WTO, and we come back to this AI because I would say for the U.S. or for the developed world, my hope would be that if there is an AI employment displacement, that we would handle it better than we did with the manufacturing displacement. That we don't end up with kind of a Luddite revolution. But it is a model change. So I believe you said you were born in 63. I was born in 62. The baby boom bulge is about 54 to 56. So in the US, very good things happen to you when you turn 65 in terms of government benefits, Social Security, the federal health care. And my team thinks that one of the things that happened under the cover of COVID, and everyone's blaming it on COVID, and I think it did accelerate it like COVID did everything, but I think under the cover of COVID, the baby boom bulge turned 65. So they were always going to leave, and that got accelerated during the pandemic, and so we've got this incredible labor shortage. I think that someone in my office told me this week there are 1,000 pilots at United Airlines who are going to make over $1 million this year. I was actually getting a UPS package when the UPS labor strike was settled, and I congratulated the fellow, and he said, "Oh yeah, my wife is already spin it." And you're seeing that. I think that you're seeing this UAW strike on autos, and my sense is that the American people are behind the strikers, which is first time in my working career that the public is with them. So anyway, that was a long way of saying we're going to see a very natural shift back from an overshoot in the amount of the profits going to capital, and it's got to come back to labor.
And a reaction to executive hyperpay and some bad behavior. Terrible behavior. And is like this leader of the UAW is quite charismatic, but he's making the point, we only want the same increase that the CEO of Ford got. Look, we just want what you get. Why did you get it? But again, on the other hand, is what's the future for those workers? So when we think about the portfolio that you run, and we'll talk a little bit about your fund in a minute, you've obviously got this sourcing of ideas and then the positioning. And Jim Rogers said about risk, you got to look down before you look up.
Yep.
And Michael Mauboussin, who I'm interviewing this afternoon at the London Quality Growth Conference, had this number. I don't know if he's right that when you were all at Soros, the success rate was only around 30%. But your position sizing must have been outstanding because you made such great returns. How do you think, is that true? And how do you think about the position sizing and the managing of that risk?
Right. So I'm glad you mentioned Michael, because he was chairman for many years of this incredible organization called the Santa Fe Institute. And the way they think about systems. And, so Simon, back to, when you said, what is macro? Macro is thinking about systems. And can the system accelerate? Could the system break down? And I think the 30% is low. That might have been a number that George Soros said about himself one time. And for American baseball, probably the most famous player in history is Babe Ruth. Home run king, strikeout king. So in macro, it's how much do you make when you're right? How much do you lose when you're wrong? And, kind of back to either, I think I told you that even though our firm name's based on a chess move, I actually think investing is much more like cards or backgammon. You don't know what the dealer is going to give you, or you don't know what the dice are going to give you. Chess, everything's on the board. Does your opponent make a mistake? So I remember being at the Santa Fe Institute conference, and one of the speakers was talking about, what confidence ratio do you need to get to increase your position? So in theory, if you can get to 51%, then you should keep getting bigger and bigger and bigger. So, I would say that, my philosophy, certainly Stan Druckenmiller's philosophy, he's incredible in thinking about asymmetry, is, what's the market giving me? What's my upside, downside? And how should I size that? I think that's what most people missed on the sterling exit from the ERM was we could keep pushing the Bank of England up against the band. They would only push us back to the other side of the band. And there was a chance that maybe the band would break. If I think about in 2012 with the yen was, as you said, the most overvalued currency in the world. And the Bank of Japan was doing the worst kept, the secret of stealth intervention at about 78. So if I was shorting the yen at 80, I'd lose two big figures, but my imagination was right. I could make 20 or 30. Right. So it is, and then it's adding when you get information, adding when things break down.
Now, this may not be true, but I was told that when you and Stan Druckenmiller presented the case for shorting the pound to George Soros, his initial reaction was one of what appeared to be dismay, but it was only because you weren't suggesting doing enough.
You have to remember, so 70s, especially the 70s, even into the 80s, markets trended much more. So if you read The Alchemy of Finance, Plaza Accord happens, the currencies move 7%, but George is adding a 300% position because they're going to keep going. So if you have a great idea, it can never be big enough. And I found, I think his quote is, it's like shooting fish in a barrel. I think there's a change in market structure, and either the fish can shoot back or the metal ties holding the barrel together have gotten bigger, and the bullet can bounce back and hit you. So you've got to be much more, you've got to be much more adept and much more attentive to the other players.
Let's just talk about Key Square, your fund. I believe you had a very good year last year. I think you're up 30% last year. You obviously have these high conviction macro views you express. You're open to new investors. Who are the sort of partners that you most like to welcome?
We like having a very iterative relationship. So I do think, for whatever reason, you tend to get these paradigm shifts, investment changes every 10 years, and they center around the decade. And I think we're in the midst of one now. And I don't know what the dominant theme is going to be for the rest of the 2020s, but I know it's not going to be what it was in the teens. It's also very helpful to hear people's incentives, what they're thinking, what they're leaning towards.
Mentors along the way who have been extremely important, and just so happens that we were talking about David Darst, who was important to me at Morgan Stanley, and David Roche, in fact, from a distance, Barton Biggs. But what was it that Stan Druckenmiller you most valued?
There's something called superstar syndrome that Michael Jordan probably couldn't teach us how to play basketball. Roger Federer is probably not the greatest tennis coach. But being able to sit, I'm not sure if Stan could explain why he always does what he does, but being able to sit next to him and watch him and have the dialogue with him. But he's just incredible. There's a great trader. I said earlier, the combination of George Soros and Jim Rogers was incredible because of Jim's analytics and then George's trading instincts. Stan's that in one person. And, his risk management, it's incredible. He's never had a down year. It's humbling. The bad part about sitting next to him is you think, I'm not good enough. Yeah, I'm not good enough. But, it's also that I go back, I'm a basketball fan. I go back and look, and if I look at the Chicago Bulls, that they were all better. Scottie Pippen, Horace Grant, they were all better for playing with Michael Jordan.
So Scott, my gosh, we could have gone on. I think I'm going to be asking you to have a reappearance next year because there is so much that is to be covered and the world is moving rapidly, and some of these big themes I think might unfold in front of us and trouble investors who have been used to a more comfortable paradigm. And I'm going to take away two specific observations you've made today. One is you define risk as I haven't heard it defined before, which is it is assessing both probability and severity. And what it is that makes a good or better macro investor is focusing on those signposts, but understanding when and how they are evolving and coming along before they influence the position sizing. And so I just want to say, Scott, fantastic for being here today. Thank you very much indeed.
Good. Thanks, Simon.